Dividend investors, bonjour, Mike Yahoo here, founder of Dividend Stocks and passionate investor. I'm back with my Canadian bank quarterly review. Last week, the big six declared their earnings for Q3, so let's dig into them. First, let's take a look at their total return since the beginning of the year. Some say you can pick pretty much any bank and you'll be fine, when actually when you look at each of them individually, they are all doing well. However, there's a big difference between ScotiaBank at 21.5% total return since the beginning of the year and CIBC at 42%. If you look at the past 5 years, obviously there's a big difference there, and I don't think that looking at the year-to-date return is a good idea, because you're just going to have like a short-term feeling of what's happening, and we all invest for the long term, right? If you look at the past 5 years, you'll see that National Bank and Royal Bank are way ahead with 160% total return, and then 99 for Royal Bank. Big difference against with Scotiabank at 48. Then again, my advice there, not financial advice obviously, but I don't think that buying all of them is a good thing, and I don't think that buying one is a good thing either. Pick your favorite two, favorite three, and then you get a good mix and you'll avoid getting stuck. Imagine if you have invested all your money in Scotiabank, you did well, but not as well as all the other banks, and we don't know what the futures will tell us. So I'm not saying that you should not invest Scotiabank, but maybe just look at having maybe 1, 2, 3 banks that would make more sense. Now, before we jump into the earnings, I'm not going to detail what exactly happened for each of them, mostly because it's the same story for all banks. All banks decreased their provision for credit losses, so that boosted their earnings. They also benefited from strong deposit and loan growth. Most of them are high single digit to double digit growth versus last year, so that was very good, and that helped offsetting the low interest rate that we are in. Overall, earnings and revenues are up double digit, and sometimes with ridiculous numbers, but keep in mind it's all related to what happened during the pandemic. And one more thing, wealth management did amazingly well for everybody. Pretty much all banks are up like 30% for their net income with wealth management, mostly because when the market goes up, assets under management naturally go up as well. And since they're making fees on assets under management, well, the largest the assets, the largest the fees, and the happier the shareholders, right? You'll also discover, if you dig a little bit deeper, that all the payout ratios are super low. The CET1 ratio is super high. And basically, we're just waiting for regulation to be lifted to finally get some dividend increase, which is not happening yet at the time of recording this video. Hopefully, it's coming up soon. But in the meantime, your dividend is safe. You don't have to worry about anything. And at the end of this video, I'm going to talk about this promise from the Liberals that they want to increase their tax rate. But let's jump now into what I did in terms of work for this quarter. Is instead of looking at what happened between 2020 and 2021, I went back to 2019 to see if the bank did better than 2 years ago, when there was no pandemic, when the market was doing well and the economy was strong. So let's take a look at them, and I'll do them in order. So first one to declare their earnings last week were ScotiaBank and BMO. So for Scotiabank, what you'll see here is not so much variation for Canadian banking. So pretty much they're very stable there, not much growth. It was a bit disappointing when you think about it. There was a lot of money that was injected over the past 12 months, and yet it wasn't enough to show some growth. In terms of international banking, well, they're still lagging. Obviously, provision for credit losses is hurting net income over there. The economy is not as developed. The pandemic has hurt a lot more, so we're still slowly walking into it, but we're still a bit nervous on that part. They started to declare wealth management after 2019, so I don't have the numbers back then, but you can see that is now a good part, 400 million in net income, which is kind of great. Overall, if we look at the total net income from those 4 segments, and how I did it is basically I went to their investors presentation for each of them and then look at the numbers that are adjusted. Sometimes there's some adjustment with corporate and other expenses that will affect the end earnings, but I really wanted to compare segments. So for those full segments, we have a growth of 10% over 2 years, so annualized growth rate slightly under 5%. It's the worst performance across all other banks, so no wonder that Scotiabank is lagging behind its peers. There you have your information. When you don't perform, you get left behind by the market. Second one to report was BMO. BMO did incredibly well. You can see Canadian banking up, US banking up double digit over the past 2 years. So even though there was a pandemic and in between, if you look at what happened in 2019 versus 2021, we still have a real growth vector over there. Same thing with wealth management. Obviously, if you look at where the market was in 2019, now we're a lot higher. So as I mentioned earlier in my introduction, more assets, more fees, shareholders are happy. The only downside, capital market is down by almost 30% versus 2019, but keep in mind that capital market is highly volatile. So it's highly profitable, but from one quarter to another, maybe if I do the same thing in next quarter, we'll show an increase of like 60% or something like that. So you cannot really trust capital market to always drive your quarter towards the right direction. Sometimes it's very good, sometimes it's okay. BMO will live and die by this word. We all know that. It's one of like their interesting aspect and at the same time downsides. So overall, net income growth over the past 2 years, annualized growth rate is at 6%, which is pretty good, but still under all the others. Now moving on to my favorite banks, National Bank and Royal Bank. So let's start with Royal. Royal Bank is showing high single digit to double digit annualized growth rate for pretty much every single business segment. So we're talking about personal and commercial up 14% per year, so which is a huge increase. Wealth management did very well at 7%. Same thing for insurance. And then capital market at 30%. So as you can see, sometimes capital market is playing in your favor. Sometimes it doesn't. What I really like about Royal Bank is its wide diversification. So if on the one side it's going sideways, on the other part it's going to do well. They also have a small segment called Investor and Treasury Services. You can see it was 118 million net income in 2019. Now it's like 88. Yes, there's a variation over there, but it's not significant. It's not affecting too much the impact on their portfolio. And even if this small segment is down 25% over the past 2 years, you can see that the annualized growth rate for net income is at 15%, which is huge, especially if you compare to Scotiabank and BMO. So before we jump to my favorite one, National Bank, if you have enjoyed this video so far, please give me a thumbs up. Please subscribe to get my video. I'm recording one video every week on Thursday, so you'll get more information about the stock market and you'll be able to invest with more conviction with those. Also, jump in the comment section. Tell me which one is your favorite bank. I'm eager to know which one is the most popular among my YouTube channel. So now let's get back to National Bank, my favorite one by far. So this one is actually showing the strongest annualized growth rate for net income. We're talking about 16%, so close to Royal Bank, but still a little bit higher. So that's amazing. You can see that the all the growth, regardless if it's personal and commercial banking, wealth management, capital market, is going up almost double digit for all of them. And then we have an impressive jump for US specialty and international segment. This is normal because National Bank recently have been growing through a lot of acquisition. They have recently owned a 100% stake in Credigy, which is a fintech in the US. And we also have 100% now a stake in ABA Bank in Cambodia. Right after the quarter ends, they also announced that they now have an 80% stake in Flinks, another Montreal-based fintech company. that will help them grow their market in the US. They're basically this fintech is helping financial institutions to transfer information from one place to another to make transaction easier and then approbation easier as well. So it looks very promising, but what I like about this part of the business is that it's very dynamic. So you can see it's doing very well. They actually made great moves, and fortunately for them, the market is now reopening, the economy is doing well, and they're well set to profit for that growth. So I really love National Bank for those reasons. And finally, a little bit like Royal Bank, they are very well diversified in terms of their source of income. As you can see, we have like 330 million net income from the classic banking corporation, now 165 for wealth management, 227 for capital market, and the US specialty and international is now growing at a very fast pace with 161 million. So well diversified, well balanced, and all in for growth. Now, let's end this video with the last two, those that have reported their earnings on Thursday, August 26, TD and CIBC. Actually, TD was a bit disappointing when you look in terms of growth. We're talking about 5% annualized growth rate for net income over the past 2 years, similar to Scotiabank. And when you look at the P/E ratio, we're going to get there in a moment after the review for all banks. You can see that they are also trailing behind a little bit. So maybe it's a great opportunity to buy it. At the same time, just look at the growth, because there's clearly a correlation between the P/E ratio and past growth and growth expectation. Right now, TD is doing okay, but US retail is lagging. One of the reasons is because they sold their participation in Ameritrade, and now they have a participation in Schwab. And when you go into the details, you realize that Schwab generated a lot less income than Ameritrade last year. So it's not the end of the world, but you can see that it had affected net income growth. You see US retail variation of 1% over the past 2 years, which is not that impressive. At least wholesale and Canadian retail double-digit growth there, so that's good. And finally, I have to mention that while all banks show very strong CET1 ratio, TD Bank is showing the best one across the big six at almost 15%. So guys, it's really time to increase the dividend. Please, regulators, look at that and give us some money. They're already ready. I mean, banks, they have low payout ratios, strong capitalization. They're ready for that, but we still have to wait. And now let's end with surprising results from CIBC. I didn't expect they were going to do that well, actually. Double-digit growth for wealth management, US commercial wealth, and then capital markets over the past 2 years. Just the classic banking activities, personal and small commercial, that is lagging behind, be pretty much flat for the past 2 years. So that's a bit disappointing, especially because it's still what 1/3 of their total net income. But overall, since they've made great progression outsides, that's great. 13% annualized growth rate over there. So that's amazing. Keep in mind, the biggest growth has come from capital market, and I've told you before, I'm going to tell it again, you cannot trust capital market to be your main growth vector going forward, because they have hectic results. So one quarter will be amazing, the other one will be meh. So just keep that in mind when you look at banks, especially when there's a big jump and then you look and you find the reason is only capital market. Be careful with that. That could be a signal that the next quarter won't be as beautiful as this one. So now let's end this video on some general comments on which is the best bank right now in terms of valuation. I've pulled out the graph for the P/E ratio over the past 5 years. You can see that Royal Bank and National Bank have performed very well, as I mentioned earlier, but they are also trading at a high valuation. So we're talking about a P/E ratio of 13.5, which is kind of high for a bank. Usually if you can get something between 11 to 12, that makes more sense. On this one, you can see that TD Bank and BMO are the lowest P/E ratio, but what's more important than the past is the future, right? So let's take a look at the forward P/E ratio, and then The top two, that is the most expensive, doesn't change much. We're still talking about Royal Bank and National Bank. Again, I think that if you are a bit uncomfortable with the market right now because it's very high and you're not too sure about what's going to happen with the next Delta variant or Epsilon variant or whatever the pandemic will bring us to the table in a few months, I would bet on a company, a bank that is well diversified. So that's probably one of the reasons why the market likes them so much and they're willing to pay a little bit more. So you have to pay for quality, right? That's what's happening here. On the other side of the spectrum, you have BMO and Nova Scotia, Bank of Nova Scotia, ScotiaBank. ScotiaBank has been lagging the market and has been lagging in terms of performance and in terms of growth for the past 5 years. I'm not surprised to see them lagging behind in terms of forward P ratio as well. I don't necessarily see that as a big sign of value. I would actually prefer to bet on TD. TD with a forward P of 11 sounds like a very good deal to me. I like the fact that they have great exposure to the US market as well. So that would be my bet today. I still prefer National Bank and Royal Bank all the time, but right now, if I had to put $2, maybe it would be TD. Now let's conclude this video with kind of news that went last week, and I would qualify that as noise. The Liberal Party said, oh, we want to increase the tax rate by 3%, so from 15% to 18% to all banks and insurance companies. So we all know they make a lot of money, we all know they're super stable, and we all know that they're amazing businesses. So hey, why not just write us a bigger check now in terms of taxes so we can help the Canadian population? First, I qualify that as noise because it's not something that has been voted yet. It's just kind of like a promise that has been bundled and packaged into their platform all of a sudden. And you know, it's always popular when you say we're going to tax the rich to give to the poor. So you know what? I'm going to deal with that news once they win the election and they move forward with their project and they actually increase the tax rate. Right now, the banks are making so much money. They're on growth path. They have several growth vectors across the capital market, across wealth management, and even the loans and savings are still growing. And now that we are operating in a very low interest rate environment, they're just going to make more money going forward whenever rates are going to increase. So I'm not too worried about taxes. Yes, it sucks because they're going to pay more in taxes and have less in earnings and obviously have less money to increase their dividend. With this big pause though, I think that dividend growth rate will still resume and I'm not too worried about that. And I'm not going to start trading based on election promises, and I think this is what you should do as well. Now, if you have enjoyed this video, if you wonder which kind of stock you should buy in the stock market right now because the market looks crazy overvalued, you know what? It will look very cheap in 10-15 years from now. And I'm doing a webinar on September 9th, and if you watch this video late, don't worry about it. You can still click on the link below in the link description to register the webinar. You'll see the replay. We're going to talk about stock valuation methods. We're going to talk about what to buy in this overvalued market. And we are going to end the webinar with when to sell your stock because some stocks deserve selling. As usual, the webinar is 100% free. Presentation is about 50 minutes, an hour, and then I'm gonna stick around for another hour to answer all your questions live, which is kind of cool, right? I usually answer like 30-40 questions, so keep them prepared. We're all there. My team is there to make sure that we log all the questions, and all the registered attendees will also receive the Q&A table with the timestamp so you can switch and then look at the one that is the most interesting for you guys. So I'll see you at the webinar. Make sure that you give me that thumbs, that you subscribe to this channel. Every Thursday, you're going to get a new video. And until the next one, stay invested.